Welcome, Alpha Capital team. That was a diva with a little bit of respect, and we'll talk about that later because I think it's something quite important. But last week, wow, what a week and a half, wasn't it? We talked about being stuck in ranges and perhaps breaking out, subject to news flow, but we're going to have to work our way through a lot of events. And boy, it started off on Monday night, didn't it, with the US Treasury? I wasn't expecting any changes to the actual amount that the US Treasury were going to ask for. It was all about Wednesday night and where they were putting it. So 55 billion off requirements, and we had a little bit of a spike that caught everybody out. There were lots of questions on the chat, what was going on. We started the week with more of the Iranian situation, taking out the US bases. That kind of dissipated. And then we did get a jolt to the system, literally with the job opportunity number in the States. That saw 9 million, and that was kind of a precursor of what the week was going to be all about, because when jolts are going up, that generally means the economy is in rude health. There's lots of opportunities. It's not unless unemployment's going through the roof and there's job opportunities there because no one's actually hiring. Then this is a real positive for the economy. People are looking to hire. And then you got the curveball on Wednesday. ADP, private payrolls missing. I've said before, it's a bit of a bad indicator these days, but normally it gets its direction right. So when it missed to the downside, you're thinking maybe non-farm payrolls will behave this week. Powell, it was all about the Fed, and did he go a little bit too far, ruling out a March rate cut? Just seems odd. A lot of people have said it's odd to actually reduce the number of tools available to you, but they've said they're data dependent. Things change. They've got the right to change, and it looks like they've got the moral high ground at the moment. The US Treasury announcement was pretty much overlooked. It was a nothing done. It's very interesting. You go to the website, you can read through the transcript rather than just waiting to see what the market says. And it's a very good review of the economy, and probably with it being Yellen, a former Fed chief herself, it's quite instructive how the Fed are thinking at the moment. But they kept the issuance exactly the same as November, taking the pressure off the long end and off yields. So we are as we were. Thursday initial jobless claims, we'd said they kept missing to the downside. It seemed a bit of an aberration, and we got the jump up. So again, just more added noise, more volatility. And then there was a US productivity number on Thursday, which was not really mentioned, but now in context with what happened on Friday, needs to be looked at. That was a big beat to the upside, and average earnings a miss to the downside. This is a quarterly based number, but it gives a real picture of how the economy is getting on. So if you've got productivity, you can get away with having a bit of inflation in the system because people are working harder. They're doing more. There's more bang for the buck, and are probably being paid accordingly to what they're producing. That should be an answer to any rampant inflation. And obviously Friday we saw the non-farm payroll come in, a second consecutive big beat to the upside, revisions up. You were all there. You saw it. You lived through it. Oh, straight away, the dollar flying off. Wages going up 0.6% per month on month and 4.5%. That was the real worry. That's what the Fed are looking at. They've got this mandate to have employment and control on inflation. So they need to get those in line. But it's probably, as I said, in real time, it's signs of a robust economy, and it shouldn't do too much other than take out the March rate cut probably for definite, unless something happens next Friday, which we're about to talk about. That's probably off the table. People start looking, though, it's not dangerous enough for rates to go back up. And so if you suddenly have growth versus interest rates and growth's winning, people look at investing in stocks. And if you think rates are coming off, then that's a double whammy. So all talks of everything being all over and an absolute smash to the floor once we start consolidating, I think be wary. There's every chance you get whipped to the upside. Now, Friday this week is something that only a couple of people have mentioned, but it's actually very important. Put it in the diary. It's in our diary. It's not in many others. 1:30 on Friday the 9th, the US CPI benchmarking takes place. This is where they review all last year's data and decide what the real rate is. Generally, over history, not a blip on the chart, but last year it missed to the upside. Came in 1.2% higher. That has to get shoved through the whole system, and the Fed realised that they were way behind on the curve, and that's what really started driving the rate hikes. Inflation was that they were following the wrong number. So Friday, very important because that could go either way. It could support, it could fall through the floor. We could have rate cuts back on. It could prove that they're right. All sorts. It's suddenly become an important number to look at. So last week, indices in the US, we talked about it last week. Be very careful here. Everyone's telling you it's topped out. You might get dragged up. Well, the US 30 was at 1.7, US 500 1.43, Nasdaq up 1%. Moving into Europe, the dollar-focused UK, that was down, and Germany flat as a pancake. So from the results, earnings, Mag 5 generally beat. Apple got hit initially on China, but with the rebound that came in post Friday's pullback, everything seemed to look as though we were back as we were. So I'd be very careful taking on some of these equities at the moment. They do look, it's very easy to make a case. I said it last week that everything's topped out, but we'll have a quick look later. That could continue building as a nest to the upside. So dollar itself, we've been looking for this correction to end. We thought it may have ended prematurely, truncated, but all the sideways movements on the back of the data, and we've suddenly had a little blip to the upside, 0.43% gain, and it looks like, I said we'll have a 104 print. We got one, and it looks like we're back to the old targets of 104.5, maybe 105. And, you can't rule out a double correction coming in the short term, particularly if something happens with that CPI on Friday that turns as dollar positive for a couple of weeks. But we'll stick with the fact that it looks like we're topping out very soon and resuming that wave 3 to a downside. Why does the dollar matter so much? Well, normally that equates to higher credit spreads. You've got higher credit spreads, more risky, then you want a high yield on your stocks. So that means that the indices, PE falls, which means the price is falling relative to earnings, and you go into what's probably a consolidation pause. But we'll have to wait for that to come through. Oil, that's had a very interesting move over the week. We'll have a look. A bit of old school coming back. We talked about maybe entering back into that range trend that we'd identified. Looks very much like there's a short-term pause to the fighting in Gaza and a bit of a prisoner swap coming. So, a lot of the puff came out of that. And, you've got to be careful. There is money on the sidelines here. If we do start to see people, the big money people, the asset allocators, if they decide that they really have got to put some money to work, there's a lot of money to come in from the retail to follow that in. There's 5 trillion of excess floating around. So be ready to buy those dips. So, we've mentioned the CPI on Friday. Today, Monday, we've still got to get through ISM. I mentioned that could possibly have a positive read through today because most of the excess hiring on Friday was done in professional services, business services, and private education, private health. That's all going to come through as strength in the ISM services today. So there might be a little bit of renewed dollar strength and continued short-term risk off. But net, if everything does, all the shoes do drop and we start to see the dollar top out, then that will be the kicker for the indices up. Gold is coming towards the end of its triangle. We'll look at that. That should be due a powerful lift up, and silver should catch up then as a speculative play. In the diary this week, obviously said ISM today. There's the Reserve Bank of Australia tomorrow, Chinese inflation data, US CPI adjustment on Friday are the main thing. There's lots of speakers. Have a look through the list. They'll be dying to get all over the tapes. We'll have a review of those. If anyone says anything interesting during the week, we'll post it up on to the various outlets. We're now, we're Twitter, we're on Facebook, we're on the Discord, we're on YouTube. Look out for anything that's important. What else have we got? News-wise on stocks, last week, obviously it was all about the Mag 5. We're halfway through the S&P reporting season. There's all sorts of names across Europe on the list. Just keep an eye out for anything that might move. Can't think of anything at the top of my head that's really going to be taking it seriously. So let's have a little look at some of the charts. So I thought that Germany, the DAX, starts to get interesting. A number of people have mentioned it to me as something that they play because of the nature of the lot sizes, etc., etc. But it's also, historically, it's been the driver of Europe. So we've got this uptrend from October 22. Looks like it's had a 1 and a decent consolidation down to 2. So we're looking at the powerful rally here. And I put in the trend lines just as we've said before. Can you see a gradient change? Very much look like we're having some form of consolidation, which may be bouncing along the bottom of that trend line. But equally, there's been a new high put in last week's trading, which means that that could be a consolidation, or it could be a breakout to new highs. See how it develops. When I was having a look at this, it looked like there'd been some interesting volume during the week. As you can see here, we'd had quite a bit of selling into the bottom. Have these bears become trapped in the subsequent sessions as it went quieter? We had a real high volume here breaking out to upside, so we're possibly consolidating that, retesting the channel before we go again. Keep an eye on that. It looks like that's the place in Europe where you might want to be chasing the market to the upside. The dollar, just mentioned it. It's been a very, very complicated sideways consolidation here, as you can see on the screen, a WXY. In fact, I actually need to take these all down one level just because it's kind of caught me out with the way it was developing. But it looks very much like we're into an ABC final Y leg, which again should come up here. We've already had a 50% retracement, and that was taken out last week of the whole move down for this wave 2. Time-wise, it's getting very mature. I'd love to see this finally finish off and give us a chance to get some performance in. So keep an eye on that. But it very much looks like we've broken into a new part of the structure here. Already seeing a bit of choppiness. There was geopolitics over the weekend that could have caused us to go through the roof, but we've had a spike up, but it hasn't really held and caused much stress so far across the indices, and the gold, having opened up this morning, has drifted back. So we want to see this play out, keep an eye on it, and equally in the very short term during the week, we could have a little market rallyette as the dollar puts in its little consolidator before finally finishing off with a bit of strength, hopefully into the end of the week in that CPI print, and then fingers crossed we get what we want to see there. I mentioned the old favourite gold, and that has been doing a classic for charting, that forever taking out the highs as it was creating this 3-leg D wave of the ABCDE that we've been talking about, which is this contracting triangle. Good to see a number of people on the chart room and the disco talking about this. It's okay for people to have different views now. With it being a final leg, they sometimes do happen and truncate very quickly, and we put in a down leg, a consolidation, and then the non-farm payrolls cause the big sell-off, and then we consolidate into the end of the trading day on Friday. Now, it's very easy to say that was going to go straight up, but to be honest, it's all happened very quickly, and I mentioned in the weekly preview, it could have been waiting to put in another down leg. I wrote that when it was around here, and that's put in a 5 wave as the first instance for the A down. So that's a zigzag. It looks like we should get a 3 wave up at some point. This should stay in the channel. 3 wave up, then we get the final 5 wave, 3rd leg down here into the E bottom, and after that, the breakout should be mega powerful, all-time highs with a bit of luck. It is all progressing. With the lines, there is a lot more structure here, so you can't rule out E becoming very complicated as a 3 wave. There may be extra consolidated in it, but the net, I keep going on about it, when we do bottom out, and you may get just a little overthrow to the line and just to catch everyone out, but we're very, very advanced in this structure. If this stays valid, stand by your beds and be very careful shorting it anywhere near this bottom line, because when that goes, we're in trouble. I mentioned oil. That looked interesting last week. We had this breakout up to the B level. I've not moved the trend channel because I thought it looked important and we were likely to come back. We were around here. We had another spike, didn't we? We've come back in, and old school classic. Everyone would be looking at that and going, "Oh, that looks a bit like a Head and Shoulders," but a bit complicated. Keeps rejecting it, and then we did have a breakdown. So it's always worth having a look at these things, putting them on. You can dismiss them. It's old school stuff. Little zoom in. What becomes important when you've got the setup, you've got the shoulder, a head coming back to the neckline, and one more. All these little breakdowns, like not once did we get a candle close below. So it's, despite the fact that neckline's been broken, it's still valid. So we're up here. A lot of people may have just dismissed it. It's gone up. Then when we got that smash down on Thursday, the first look, we've closed down, and that drags the whole thing. You get the height of the head repeats to be the target for the pullback, and look, matching up now, bottom of the trend channel, and 1 for 1. Perhaps we're due a little bounce. Keep an eye on it. But either way, that was quite instructive. It's just classic old school. We haven't got to get super clever on these things. Not everything works all the time, and it's good to jump around. Look, that should have been on everybody's list as you saw the structure building. Good luck if you spotted it. Well done. Back to the US 500, the S&P. We talked about previously here where the advanced decliners versus the 50-day moving average had dropped back to being 70%, and that was a sign for a little bounce when decent earnings came through. We've since powered up, on again with the volumes here. There's big volume into all the lows here. So another one that's had a classic bear trap. We're getting squeezed up. We've had a consolidation around some of the earnings, and then we've dug in again. Everyone keeps getting trapped. This is where you can see structure build up with the volume. Lots of people taking it on. It's the end of the world, and then getting whipsawed up. This is where you get the nesting, the 1s and 2s. So we need to be very careful here. Keep an eye. Like to be bearish. You'd like to see this come back into the channel. May well happen. Could easily be an expanded flat. Drag the 2 over here. Not really concerned unless we're down towards the bottom of this channel here. We could easily have that 10-20% classic retracement. It would still be valid versus the 2, unless we take out the absolute 2 level low there. Then I wouldn't be getting too panicky about this being the mother of all sell-offs that some people are trying to line up. In fact, to me, it feels more dangerous as a breakout to the upside. Obviously, and I'll talk about it in a minute, but there are lots of different ways of looking at markets. It's more instructive that you actually do look at markets, do your back testing, do your charts, you find the indicators that work for you over time, be comfortable. The market is a combination of sentiment. It's a sentiment engine. It's everybody's views. You could argue that at any one point, everyone's view is correct, but there's going to be a predominant trend and something that is totally in charge. Hello Teacher's giving me lots of pushing to use the pitchfork, and I'd like to do a session with him, just applying it to my NASDAQ chart, which we'd built up for the breakouts. That's auto picked out the same trend. Looks powerful to me because I've got 2 confluence areas here of the wave 1 and 3 relationship being a 1.618 comes there. The whole 1 and 2 angle and the internal structure here of the 5th wave of the actual 3rd wave being a 1.618. So that line looks extremely attractive. Looks like we're probably going to test it, and it's the top of the pitchfork itself. So I like to build these things up to see them myself and to play around, and maybe that's just because I've been doing it for so long. Some people want to use the automated tools, take all that out. I'm just someone that likes to read and see. It's my style. I'm very happy to then overlay other things and to see whether it matches. But that's something for us to talk about, and there's all sorts of sexy things that we can put over the top of this. But anyway, I've got one final point to make. If I can get back to the right sheet. So going forward, I would like us all to try and work together. There's mediums for it on Disco, or we can do it on the live session. I'd love to have more chat on my Disco channel. Very open to talk about anything to do with the markets. But we had a very, very good session this week, talking to 7 of you traders out there that have all got special backstories that Alex had selected, and really, really instructive. And everybody's gone through, quite a difficult period to get started, and they've had to put in lots and lots of work. They've found their way, and the journey can come from all sorts of different angles. You can be a former institutional side guy like myself, like one of the guys on the videos that you'll see in the weeks to come, or you can come from all sorts of walks of life and have had all sorts of problems or not problems. But the key overriding theme to success is that people put a lot and lots of time in. They're not just gambling around. They're working, they're being patient, they're finding what works, they're finding their way. And they show a lot of respect, as we mentioned with Adiva at the start of this. So I put a little bit of a preamble that you can all read through, but essentially I'm talking about we need to respect everyone's view, everyone's different ways of looking at the market. There's lots of ways of describing things, break of structure, breakouts in the market, change of characters, trend changes, reversals, weight of money, imbalances, volumes are always important, demand and supply, the support and resistances. It's all about you finding what time frames work for you, which of those indicators work, but do the work, be systematic, analyze it, create your mindset. We've gone on about it. Lots of the guys giving you help on the trade mate and the Discord and online. They're all when they're genuine, they're coming from the same place. You can make it complicated. You can have a script. You can be, almost a computer whiz creating things, or you can just have the most basic of things. Whatever works for you. If you don't, it's good to keep a clear mind. You don't necessarily have to overlay stuff, but be consistent with what you use. Don't fight your own signals. I've mentioned it, I think, on my preamble video. You stay alive in these markets. You've got to be able to come back tomorrow. Don't let the psychology of a bad trade override you. Don't keep it going just for the sake of not losing. It's difficult as a beginner to get through those kind of feelings. It's difficult when you're experienced because you don't want to look stupid. But it's all about doing the boring stuff consistently, working out your ranges, working out how much you can lose if it goes wrong. It's going to go wrong. 51.49 is good, and if you've got the staking right, you're going to eke out, a chance of winning if you get the percentages higher relative to good staking. Good staking has always been the parameter for any kind of investment. Make sure that you can survive. Allow for the fact it can go wrong. It's great if it's going right, and you can potentially add if you're in form and you're following a trend and getting it right. But don't just throw the kitchen sink at the first challenge that you do and then go, it doesn't matter, I'll just buy another one. You can do that, but that's probably not the best way of learning. Go into the demo accounts. Save yourself the stress. You're not looking to go bankrupt here. You're looking to find a way of changing your life. And you'll see with the videos of talking to the people that have become successful on this, they are doing life-changing things. So keep in mind, there could be a fundamental change. It's something else I've mentioned in today's thing. There's some people out there that they're absolutely adamant that talking about economics fundamentals doesn't matter. I think it's lazy and it's a bit arrogant. It may not matter to you. You might not be interested, but it does drive what goes on in the markets. If you're trying to follow money flow and liquidity changes and respecting price levels, it's all driven by what the big money's doing. Is it what's changing their trend? What is going to force them to change, stay strict to their stop loss, or are they going to ride out the little breakout because they know they're coming in with a much bigger sell themselves? Why are they going to do that? Because the picture's changed, or there's confirmation that their position is right. And if they've got 10 to 1 more money than the people that are driving the market up, it's going to go back to the original trend. Respect the data, the fact that does have, it may not be the correct immediate reaction because a lot of people like to review it. They go into meetings, they'll have investment meetings before they make that big decision. But this stuff will flow through. It is what creates the consensus. As I said earlier, all of us are right in some juncture, some time frame. A stop clock is right twice a day. That's the old classic in the markets. But we need to be cognizant that our view and our setup and our strategy might be wrong for current market conditions. That might be that you're having a losing run. You can't understand it. This has worked. The back testing's worked for weeks. Has something changed? You've got to allow it in. You've got to look for it. Are we helping on the site? Are we giving you any clues? We're talking to you about things that isn't generally in the mainstream. No one talks about the US Treasury funding requirements and where it might be on the curve. No one's really talking about US CPI benchmarking at the end of the week. They should be, because it's suddenly become something interesting. So do your work, keep your mind free, try and find the rhythm of the markets, find your rhythm, show the market respect, show your setups respect, show yourselves respect and others.